welcome on board Vimal Kejriwal, the MD and CEO at KC International, to talk about their numbers. Vimal, hi, morning. Great to have you on ET Now as always. I want to first start talking about your margins, because despite some sequential improvement, it seems that they're still, they've fallen short of analyst expectations. Tell me, what is keeping this pressure on the margins?
So morning, Aisha, and thanks for having me. I think what is happening is that there are some factors still, we are in multi businesses. So, railways and transmission and civil. So I had been talking about some setbacks in railways. I think that's what has kept our margins slightly lower than what we would have wanted it to be. Secondly, I think the revenues were impacted slightly, maybe 300, 400 crores from the new projects due to some of the supply chain issues. Had we done that, probably we would have been maybe 30 basis points higher than what we have been able to achieve.
So do you see further pressure as well coming in? When is it that you expect margins getting back to double-digit levels?
So this year, our overall margins were at around 6.1% for the year. Next year, we are targeting around 7.5% for the full year. So obviously, Q1, Q2 would be at slightly lower level. Q3, Q4, the margins will start picking up because we're talking about 7.5, maybe towards 8 also for the full year. So we do expect that by the end of, exit of Q4, which is what we have been saying, we should be close to, I'll say 9 or 10% by exit 25.
Morning. Now, you had guided as well for an overall revenue of 20,000 crores and you delivered almost that. What is the outlook now when it comes to FY25? Will you be revising the overall growth guidance?
Morning, Aman. I think what we are looking at is roughly around 15% growth. So we should be touching a figure of around 23,000 crores. That's what our number is projected for FY25.
Enough. And given that after over 18,000 crores of order inflow has come in for FY24, what is the pipeline looking like? Which is it that in terms of segmental growth that you're expecting the most growth to come in? If you could just break it down for us.
So we have, as you rightly said, 18,000 crore intake, which means that we have an order book of roughly around 30,000 crores and another L1 of 7,000. So we are virtually starting the year with 37,000 crores, which is almost, I'll say, 6 to 8 quarters of visibility for us. As far as the tender pipeline is concerned, as of today, the tender pipeline is around 1,35,000 crores. This includes some tenders which we have quoted, not yet decided, and the tenders to be quoted in, let's say, next 1 quarter. Roughly 45% of it would be in the T&D sector, and the balance would be, in civil, railways, etc. If you look at the focus part of it, where do we expect growth to come in? I think maximum growth would come in from the India T&D sector. Today, if you look at this year also, we are closing the year with almost 9,000 crores of, order intake, order book plus L1, etc. And we are still seeing another 25,000 crores in the tender pipeline of what we told you in the India T&D. So I think the biggest and the fastest growing would be India T&D, and then I think followed by civil.
And what about your international order inflow? How's that momentum been, Vimal?
So international, this year we got around 4,100 or something of an orders. A couple of large orders did not materialize. We are L1 in, I think, close to 2,000 crores of orders. So last year, international grew well. So this year, we don't expect it to grow so fast as compared to what India T&D and civil will do. But international will also grow. And if you look at the areas where we are growing in international, it is primarily Middle East and not just Saudi. It's now UAE, which has come back with a vengeance. So we are seeing a lot of tenders which are coming in out of Abu Dhabi. Saudi is there. We're also seeing a lot of supply inquiries coming in from the United States. So we are also seeing the tower supply business picking up in North America.
Vimal, I just want to get back to the point that you were earlier making on the domestic business. You were attributing the margin softness to actually setback in railways. Tell our viewers in greater detail as to what is the nature of this setback that you're talking about, and whether you see this as a lingering impact, given that Q1 is also going to be sort of an election quarter.
So to me, actually, there are 3 or 4 reasons why this is happening. One is clearly we saw in the last 1 year or so, the focus of government was more on running more trains and station redevelopment, etc. So somewhere I think laying of tracks, electrification, etc., did not get the sort of priority or cash flow funding as it would have normally got, which we now expect that once the elections are over, with the huge allocation of capital for the railways, we do expect that infrastructure spending on railways will come back post the elections. So that's one I'll say macro reason. The other two issues are more in the way the contracting is now being done. Earlier, the contracts in railways were being awarded by, let's say, people like RVNL and IRCON and RITES, etc. Now it has moved into divisional railways. So divisional railways have their own challenges in the way they work, etc. And the third major issue is from a BOQ-based contract, it turned into an EPC where designing was in the contractor scope. And then I think we have been facing some challenges on how to get the people to accept the designs, etc. So there have been some setbacks in the current contracts, but we do expect that going forward post-election, we will see a huge turnaround in the order intake, etc. So next year would still be a muted year for railways, but based on the tenders which will come this year, I think FY26 should see a large turnaround of the railway business.
But since you are attributing, and apologies if I'm probing a lot more because, one needs to understand this. Since you are attributing, two of the reasons which are sort of outside the ambit of, elections and the capex spend on railways in particular, does it seems like, the peak that you had in the railway segment, that's not going to come back, even though it may recover from what you posted in this particular quarter, Q4 that is?
So if you look at our numbers, I think a year before FY23, we had 2,500 crores of order intake. I may be a little bit off on them, but it's roughly around that. This year, with our L1 and order intake, we're around 1,300 crores. Next year, we are targeting to get probably around 4,000 crores of order intake. So we are looking at a turnaround. It would all depend upon the outlook of the government expenditure on which parts of the railways they want to spend. If they come back and start spending on infrastructure, I think the business will turn around.
Good that you've clarified a little bit more about what the outlook is when it comes post-election and railways and seeing that overall recovery. I wanted to get in a sense from you as well when it comes to the net working capital days. They continue to be above 110. What is the strategy in place to bring that down?
So if you look at our numbers, it's come down significantly from the peak 6 months back. We are now back at the same level as we were at the start of the year. The debt levels are also at a similar level, but then we have had a 2,500 crores increase in revenue. So if you factor that in, the debt relatively has come down. Also, if you look at our interest costs as a percentage of revenue, Q4 we have reached 2.5, which is one of the lowest we have seen in the last 4 quarters. We were at a peak of 4% in I think Q2 or Q3. Our guidance is now that we should be around 2.5 for the next full year. We don't expect the debt to go up again with a rise of 15% in the turnover. So I think overall we are quite happy with the performance on the debt front. We have been able to reduce what we had promised that we will do. And also this 2.5% for next year does not factor in any decrease in the interest rate globally if it happens.
All right. Thank you so much for taking time out. Good to get to know a little bit more perspective as to what the road ahead for KEC International looks like.
If you like this video, then like, share and subscribe to ET Now.